Welcome back to the Canadian Investor Podcast. I'm here with Dan Kent. We are back for some news and earnings here. So, pretty slow on the earnings front, but thankfully, we got some macro news that is helping us out and giving us some more to talk about this week.
Yeah, definitely. I mean, inflation. I thought it was a decent print. You seem to think a little bit different. I'm sure we'll discuss that, but obviously the Bank of Canada did too, as they followed through with a rate cut. I mean, the difficulty here is the economy is so weak that even if inflation came in higher, I think they still would have cut anyway. They're in a pretty
Yeah.
tough position right now. But yeah,
Which
that'll
is
be
funny because officially their mandate's not like the Fed, right? Officially their mandate is price stability.
yeah.
But it's funny how they tend to forget that a little bit. And I'll mention with a bit more of detail why I think it wasn't that great. I think in their interest rate announcement, which breaking news, it just happened like literally 30 minutes ago at 9:45 a.m. So we're recording this just a bit after 10. So we will be talking about that. But I think they stretched it a little bit, to be honest. Obviously, the economy is slowing down. That's totally fair. But when your mandate is price stability, not quite sure I fully agree with that, especially given that a lot of the lower inflation print is because of low energy prices. And when you start looking at core inflation, it's quite sticky, to say the least.
Yeah, what was that? I think it was 2.5%. So I don't know if maybe the target is being more so moved towards that 2.5, 3% mark versus, you know,
Oh, it's actually higher than that. So I'll just share my screen here
oh, is
for
it?
Join TCI. Yeah, subscribers. So you'll see that it's actually higher than that. So if you look at the core inflation, so we'll start with CPI data. So the core inflation, for those not familiar, it's just the metrics that the Bank of Canada tends to focus a bit more. There's CPI common, CPI medium, CPI trim. CPI common, I'll be honest, always kind of been a little bit confused with that one. And I've listened to a lot of people that are smart about this stuff, and most of them are also a little confused about it. So it's not just me. That's good to hear. The CPI medium, just think about it that if you have a whole bunch of different categories and items, you just pick the middle one, not the average, the middle value, and what that value is. So there's as many items or basket items that are below that and as many above in terms of the inflation rate. So that one came in at 3.1%. Has been very sticky. Actually, has been back in March, it was 2.8. And then it's been essentially at 3 or 3.1 ever since. And then if you look at CPI trim, that one removes the most volatile items, including typically food and energy. And that one is at 3. And granted, it was 3.1 in July, but 3 is still not great. And that's the reason why I think it's actually not that great of a print if you look at that, because you can just use the energy component and say, okay, the headline inflation came in at 1.9%. But if you start looking at energy, I mean, energy is playing a big part at keeping that low right now. Energy being down, I believe it was down
Double digits. Or
8.3%.
yeah,
And
pretty
yeah,
close.
gasoline down 12.7%. So it just goes to show that, yes, there's some, it's definitely a mixed report in my opinion. And the fact that they decided to cut rates and disregarding almost or saying that it's looking not too bad for the core um, is a bit worrying, because they're probably thinking that the economy is way worse than they originally thought. And if they were actually price stability, I think they would probably have waited a bit longer to decide to cut. But that's my 2 cents here.
Yeah, I mean, what is unemployment at? It's at like it's ticked over 7%, I think.
Yeah.
Job
Yeah, it does.
losses, I
Mm.
mean, yeah, what 1.6% decline, annualized decline in the economy. So I don't know. This would be a very tough job to navigate right now. I mean, obviously, as you mentioned, like energy is going to be definitely the most volatile. There's not a lot of, I guess, short term bullishness on energy. I mean, if the economy gets that weak, I can't imagine we see
No, no,
oil,
yeah.
going up recently. But as we had talked about this before we started recording, like over the next, 3, 4, 5 years, um, maybe a bit more bullish. But I don't know. I kind of think they had to cut. I don't think they could have held steady just because of how poor the economy is. It's going to be interesting because I have a mortgage renewal coming up in the next few months. Whether or not this kind of pulls down bond yields, it's going to be interesting.
Yeah, I mean, and variable may make
Yeah.
sense if you're looking to kind of take a bit more of a risky approach over the next couple of years. You will have to see. But just a few more points here on CPI. Food prices were up 3.4% year over year, but flat compared to July. Meat prices were actually up 7.2% following a 4.7 increase in July. So if you're a vegetarian, congratulations. You probably didn't feel the increase all that much. Makes me want to switch over just for a financial reason at times. Fresh fruit saw a decline of 1.1% after a 3.9% increase in July. And obviously, the 3.9 increase in July was year over year. The biggest reason, again, it's energy that it was down. Now, services, which have been still pretty sticky, they were up 2.8% year over year. And shelter remain pretty elevated at 2.6%, although you can definitely make the case, especially if you start looking at rents in real time. And I know Dan Foch from the Canadian Real Estate Investor Podcast is pretty vocal on that. And I think the guys from the Loonie Hours, Steve Saretsky as well, has been pretty vocal where you're really seeing rents decline in a lot of metro areas across Canada. So whether that number is actually a little bit inflated, I'm not sure, but you can definitely make the case. And of course, rent is not the only thing. There's like owner's equivalent rent and all these other things that come into it. But I wanted to mention that. And a quick note I wanted to mention, which for those not familiar, when you get on the CPI side, you'll actually get like a full kind of overview of, the biggest movers. They give you like a little bit of a summary. And they had a section here. I'll try to show it. Travel tours push down the cost of travel services. Like, really? Like, who cares, really? Like, this is just to me an example of the CPI basket not reflecting what your personal consumption is. Because if you're a Canadian that's struggling to make ends meet, what do you care that travel tours have gone down? You do not care whatsoever because all your money is probably going to food and lodging. And I mean, I think we're in a good situation financially. I think you are as well. And I mean, I couldn't care less that travel tours push down this, like, essentially, I mean, unless you're in the travel industry, like, it doesn't really matter. And I think this is one of the biggest issues with the official CPI metric is they try to incorporate all these things and you have this headline number. But the reality is that it probably really doesn't reflect your own personal consumption. And sometimes I would hope that they would make almost like three basket, like one for lower income Canadians, what kind of inflation they're seeing, one for maybe middle income Canadians, and one for a higher income Canadians. Because then the higher income, they'll have more discretionary spending that would be incorporated with that. I know it would be a lot of work, but I think that would actually reflect much better the reality for people than just this one number and telling us that travel tours push down the cost of travel services.
Yeah, I don't know. I don't know how you have like on your headline page, like you have all sorts of things that you can talk about that impact like the vast majority. Because there's nothing on this main page that talks about rent or mortgages or nothing, like on the main headline page, but they talk about travel tours. So yeah, it's kind of strange because
they love saying that cell phone prices are down or going down. So that is one thing. Again, sometimes I think a little bit that there's a bit of a political angle to all of this because if you think about the last 10, 15 years, the federal government has been very kind of out in the open saying that Canadians were paying too much for their cell phone services. So maybe that's a way for them to show that. But anyways, we have a decent amount to talk about. So I won't go too long here. We'll go to the Bank of Canada announcement. So like we talked earlier, so the Bank of Canada lowered its overnight policy rate from 2.75% to 2.5%. It's important to know that this is a variable rate. I didn't check the Canada 5-year to see how it reacted to the announcement. Probably not all that much because it was likely baked in, I would think.
Yeah, I'm trying to look it up. It's flat. Yeah,
Yeah,
like it
flat.
hasn't
So
moved
it was
much at all.
probably, yeah, I would think it was probably baked in. And of course, the press conference I think is about to start at any time now, so we haven't had the chance to look at that. But they always release kind of a statement just to explain what happened. So they said the cut reflects a weaker economy and reduce upside risk to inflation. Global growth is slowing after showing some resilience in the face of US tariffs. In the US, business investment is strong, but consumer spending and job growth are both slowing. That's a bit of an understatement with the kind of numbers we saw in the big revisions, but of course, they don't want to throw them under the bus either. In Canada, GDP fell 1.5% in Q2, something we talked about, mainly to tariffs and trade uncertainty. And they said that exports fell 27%. That's because businesses actually front loaded a lot of shipments before tariffs would take effect. The business investment side also declined in Canada while consumption and housing grew at a healthy pace. That one is a bit of a head scratcher. Maybe the lagging data they're looking at, but I think we're probably going to see more and more people cutting back, especially if you're seeing unemployment rise. Employment has weakened in recent months, especially in trade sensitive sectors. Core inflation were around 3%, but upward momentum has eased. That can quickly change. I would say, yeah, it's kind of stable at 3%, which, let's be honest, that's pretty much at the top end of the target and verging on being over their target. They said underlying inflation is estimated at 2.5%. What the hell that means, I'm not quite sure. Federal removal of retaliatory tariffs should reduce future price pressures. The rate cuts are intended to balance the risk between a weaker economy and making sure inflation is still under control, which again, their main concern should be price stability, which is something that we've talked about in the past where it may be the official mandate, but let's be honest, like the economy is definitely, it may be the official, but in reality, it's economy and inflation. It's not inflation. People can debate me all they want, but I think we can see it in this announcement where if you start looking at core inflation like we just talked about, it's hard to make an argument to not wait. If that's the only thing you're looking at, it's really hard to make an argument that they should not have waited at least an extra meeting to make that cut. But once you start factoring all this other stuff that they're talking about, then of course the cut is probably warranted.
Yeah, I mean, if their objective is stability, they've definitely had stability. It's just kind of on the higher end of, what they've historically targeted that stability at. But yeah, it's stable, but it's like, high.
Yeah, exactly. So, I mean, to wrap it up, like longer term, I think it's going to be very hard for central banks, Bank of Canada included. Like, if you're thinking 2, 3, like probably 3, 4, 5+ years down the line, I wouldn't be surprised that inflation remains really sticky or even higher. And, surprisingly, at some point, they come up with a new target inflation rate. And instead of being 2%, now it's 3 or 4%. May not sound like a lot, but it does pretty quickly diminish the purchasing power that you would have and kind of reinforces the reason why you invest. Because if you just keep your money in cash, and of course it's good to have some cash, and you try to find places like EQ Bank that will give you a decent interest, at least compared to competitors. But at the end of the day, if you keep too much cash, you're just going to get eaten alive, and you need to invest in assets long term to be able to keep that purchasing power. It's so tricky because you don't want too much in cash because then you get eaten by inflation, but you also want to have some because if you have some short-term expenses, because if you put too much in assets, then a big correction and you need that cash and you're kind of screwed. So it's really that delicate balance for investors. And if you're thinking it's not easy, it is not easy. Like even really top professional money managers, like they struggle with that too.
Well, and I mean, even if you do get to that 3 to 4% inflation target, like the people it really hits hard are the lower income people who just don't have the money to invest in assets. Like they're pretty much living day to day with prices increasing 3 to 4% a year, and they're really not, purchasing power. Like they're just trying to survive.
If you'd like to listen to the full episode, head to your favorite podcast player and type in the Canadian Investor Podcast. If you'd like to watch the full video, go to jointci.com and you'll be able to subscribe to our Patreon page. On top of that, you will get the podcast feed ad-free. You'll also get our monthly portfolio update and my parents' retirement portfolio update, which I manage myself.